was occupancy and usage. So how many occupants were in a given building at any time, especially when you're talking about multi-family dwelling units, where what's the ebbs and flow of family size. But a lot of the data for driving that underwriting was self-report or survey. So my thesis was more or less of, this has an inherent flaw in that type of data gathering. Wouldn't it be better if there was a world where we had more real-time and accurate information from the source of truth, wherever that might be, whether that is a data exhaust from a workflow, so post lending and around a single-family home, or if it was on the move-in dates, we knew exactly the family size that was there. What could we drive to get more accurate information on real estate investing, right, and how that would impact potentially other models. So from there, in the last 10 years, I've been on that mission of real-time data and information in real estate, which is an extremely opaque and fragmented market, almost by design, actually more specifically, very much by design. We can dive into that in a moment. So I joined pretty early through my mentor, Bob White, who was the founder of Real Capital Analytics, which sold to MSCI about 3 years ago for about $1 billion. One of the best exits in the real estate tech space. You can make $1 billion in real estate tech. It's pretty uncommon.
Unicorn is possible.
Yeah, it's possible. It's possible, yeah, actually with cash, not just on paper. And Bob introduced me to one of the first startups in the, or breakouts in the PropTech space, which is called VTS. And VTS is now the largest leasing and asset management platforms. But at that time, this is in 2014, there's only a couple hundred companies, maybe globally, in PropTech. And then flash forward 2-3 years later, we saw tens of thousands of companies in the space. And that was a maturation and a shift of the buying power, at least the awareness of the landlords, Brookfield, Blackstone, Hines, Stronghold out of Sweden, who started, and Newsec started to say that we could take the potential revenue opportunities from the companies that we are being introduced to, and we can also invest in them and help them scale. So that was VTS's model. Our investors were our customers, which was representative of the largest landlords in the world, and I was responsible for their integrations, deployment, implementation as a solution engineer. So traveled 3 cities a week for 3.5 years all across North America. It was pretty tiring in some cases. And then switched over to the venture capital side. So I ran capital markets and platform for Metaprop, which was the first PropTech early stage VC in the category, which worked hand in hand with Magnus and Daniel from Stronghold. They were an investor in LP, and that's how I was introduced originally to Sweden and the PropTech zones, and then became very much, I had my own conviction in the thesis of Nordic-based and Swedish-based PropTech investing and LPs into North America and vice versa. And then as of late, I still maintain my position in the venture capital world, but have now pivoted back over to the operator side. As you saw, the venture saw a 10-year bull run. Then after the rise of interest rates, the drying up of the general capital markets in Europe, North America, I decided to go back to operator, and I'm now leading North America for a Blackstone portfolio company, or Blackstone and JLL and ING invest in this company called PRODA, which is the first AI-driven automated rent roll standardization and cleansing platform that solves a fundamental problem across all of commercial real estate, regardless of language, currency, and measurement, but still really focused on the general PropTech and real estate and built world innovation, as well as have been teaching at the University of Virginia for the last 6 years. So I get my my academic licks when I can.
Yeah. All right. So that was a lot. I don't know if you all were able to keep up, but basically you've had a background as an investor and we're working for a venture capital firm, but now you're back working for a PropTech company, you can say.
Yes.
So you've been on both sides of the table in a sense. And do you perhaps want to give us you mentioned a few of the companies and the success stories and the exits and so on, but what are some of the big PropTech exits or success stories that come out of the US? I mean, I know a few that's been actually IPO'd and gone public, like Open Door, for example. But there are also some private ones and the ones that have been sold and so on. Perhaps a few of the most famous consumer-facing ones have been Ring and Yeah, there are other ones too, Nest and so on. I think that was sold to Google. Or,
Yes.
Yeah. So do you perhaps want to give us a few examples from your point of view?
Of course. I mean, I think there's one thing to highlight is that unfortunately that against the S&P, PropTech, publicly traded PropTech companies perform generally around 20% less of value across the S&P trend line. So we're yet to really have fantastic performances of PropTech, publicly traded PropTech companies, and that's because they IPO as tech companies, when more or less most of them are PropCo OpCos. So it should be valued as a real estate company. So take Compass, for example. Right. It is a brokerage company that has a core infrastructure of tech that it gives to its brokers, but it's still a services business. It doesn't have a tech multiple. So that tech multiple is driven by subscription services, which then you can raise the price, but that's just not how brokerage works. You don't value them the same way, but they have been valued on their IPO. Airbnb was also, it is still technically driven by the real estate market, though it is a marketplace, but you don't see the same margins as you would on, say, a 20 to 30x tech-style company. And that's been a learning curve for how we would IPO a lot of the PropTech companies. I think a lot more of the value is driven on the private markets and private M&A. So Matterport, for example, which sold to CoStar about, I would say, 2 months ago, and that drove, I think it was 160% value of its privately owned share price into CoStar, raising CoStar's general IPO, but that was a thoughtful acquisition that was going to improve the product set of CoStar. So that's been a really great exit. A lot of those that invested in those. There is an interesting flip side of success is, again, back to the dearth, there is now a graveyard of PropTech companies, which is a Twitter or X account, which covers all of the failing PropTech companies, which has been almost like 10 a month. You know, there's 15,000 globally, but I do like the washouts for many reasons. One, it brings good talent back to actual growing companies with revenue producing business models. And you see a lot of that now happening with a lot of the AI companies, which we can touch in later. But I think Matterport, RCA, and even the success of VTS's acquisitions. So in my time there, we acquired 4 different companies. And those have been successful of integrating them inside the core platform. When PropTech first started, there really was no exit. Like where could we go? Minus to Altus, CoStar, and even a Yardi product. You did see recently that WeWork did sell to Yardi, which that'll be a very interesting structure to see how an accounting software can handle a co-working space.
Right. So it's been a tough market for PropTech companies and for PropTech investors as well, then that are trying to make some kind of exit in those companies. But I think it's an interesting point of view too, because having lived in the U.S. for 12 years and being very close to Silicon Valley and so on, I mean, even the name of the capital structure, it's venture capital in the U.S., which comes from adventure, right? And they see it as an adventure a little bit. I mean, you know that a lot of these companies are going to fail. It's high risk. Whereas in Sweden, it's called risk capital, which is risk capital. So you look at taking a risk in that sense, and you do in an early market. But that brings us into the definition of PropTech, which I think is interesting to go into as well, because you mentioned Compass, which is a real estate broker service firm, right, that IPO'd. In Sweden, we have another version of that, Hemnet, which is an advertising platform basically for private real estate. And that has been a success story since it IPO'd. But it's not really a PropTech company in that sense, in the definition of it being a SaaS business and so on. It's really just taking an online advertising model and applying it to real estate. So how do you define PropTech these days?
I think that's a really good point of going outside of the real estate or real estate tech forums to find great technology that can actually be utilized by the property business. The very simple definition is on Key Bono, who benefits? And if your ultimate decision maker is, as a tech company, so say you're doing boiler management or predictive services on maintenance, right? So who ultimately makes the decision? Like, well, it's actually this property manager. Like, you're in PropTech. Like I'm trying to find
Who's the buyer, right?
Who's the buyer? There's so many companies that I'll talk with in the general tech space that all of a sudden realize that they're actually just PropTech companies. Your buyer is a real estate investor, a property manager, or the consumer that resides in a dwelling unit. Even in this physical space, event production companies still technically count as PropTech companies. You do need to rein in the definition as to what category they are, because they won't get one multiple.
But do they necessarily need a tech multiple? Because you were into that earlier, though. If they're an event company, you don't really have that kind of exponential growth curve that the SaaS company can have.
Exactly. That's where you break down. Is this a services model? Is this is this SaaS? Is this a PropCo? OpCo is a property company, an operating company. Which part of the definition you have will allow us to be able to better identify which multiple that we can place on you and which return and yields that we can get and what kind of investment. That's been very difficult to discern, especially in the early days in PropTech when we were just trying to identify what the definition or what we were doing, but who we were selling to. Now that we've seen several turns of this, so within truly, I think we're 15 years in this latest iteration of PropTech. PropTech truly goes back to 1976 with the first advent of J.D. Edwards. You can go all the way back to 10,000 BC if you talk about the burlap tent, but I'll rein it back in to be even more myopic in that it's been truly 15 years of one single category that's now breaking out into construction tech, resi tech, so rent tech, as you talked about, Open Door. Yep. That's been led by RET Ventures, and that is much more consumer driven. So you have the build to rent, or we call multifamily, so build to rent. In Europe, that is driven much more by the resident and whatever technologies or renting services and financial services that they might be using. And that's given us, and then there's the flip side of the commercial side, which has an incredible ebb and flow on its own 15-year cycle. So it's pretty fascinating if you see the consistency and the reset of real estate innovation happens on, as a professor Geltner that describes the 15-year real estate cycle. And every 15 years, the real estate will rise, and then tech will rise with it to service that industry. And as soon as real estate takes a dive for, its general cycles do, the first thing to go is real estate tech and innovation. It's the first team, which is ironic because that's the team you need the most in downturns to be able to extract value when there is no opportunities, but they go first. So then you're always resetting. So if you look back to like the mid 80s and even in the late 90s and like the 2000s, you'll see companies, marketplace companies and hospitality driven tech companies that were now reinventing but the same exact models in the last downturn and cycle.
Right, because that goes back to what's your core business, right? And that's perhaps something that has changed in real estate over time, because I'm in communication and I used to be at the marketing agency too, and that used to be also the first services that you cut in a downturn, whereas that's really what you need then to get your name out there and actually be able to do sales, because if it's it's a good market, the customers are coming in and everything is good and you really don't need to do that much more. And in real estate, it's kind of the same thing, right?
Yeah, that's why if you look at great or breakout PropTech companies, they focus on a pain, so an opportunity to solve a true issue that will remain consistent and even be exacerbated in a downturn. So, for example, when I was at VTS and when oil took a big dive, and I know oil is more of a Norwegian thing, but when oil in Houston took a big dive, so it went from $100 a barrel to like just about like $3 or $1 a barrel. That was one of our best years. We took the entire market of Houston. The reason being because in office leasing, there were no renters. There was no deals happening. Mm-hmm. No one was taking more office space. So all the landlords, so you think of like the Hines, the Paramounts, they're looking across and saying, what is my broker doing? Are they doing nothing? Are they sitting around? How do I manage them? Because you can't control what you're not measuring, and you can't improve it if you're not measuring it. So what was the best opportunity was, from a sales perspective, we'll give you transparency into that deal pipeline. We'll let you know what the activity, the tours, the interaction with your tenants, and the relationships with those tenancies that are otherwise in siloed systems. So in legacy accounting systems that the asset managers and the CEOs did not have access to. So by layering on a transparency tool, they were able to then find and identify and improve the deals that they're working on. And I think back to what we're working on at PRODA, which is, again, back to exposure, just standardization of your potential exposure. One great use case, or an unfortunate but a true use case from a few of our clients is after the invasion, Russian invasion of Ukraine, a lot of the clients said, well, what is my exposure to corporates based in Russia and in Ukraine? Like, how much am I exposed? And they cannot answer that question because there's a lot of tenant accreditation and tenant name cleanup that has to be done, especially on the standardization of the parent-child relationships. And that type of work takes a lot of time. So to instantly answer those questions and focusing on that type of transparency and telling that narrative and story that we can help reduce and de-risk you as a landlord, as a real estate and property manager, that's the type of companies that will survive through downturns and cycles.
Right. And another type will also be the kind of companies that can bring in new revenue to the real estate companies, right? And we're starting to see a lot of this, some spectacular failures as well, yes. With WeWorks and so on. But using space as a service and finding new revenue streams from tenants to real estate owners and real estate operators and so on. How do you see the development there in the US right now?
So I love that concept. It is difficult to do the change management of the revenue model for landlords to convince them that they actually have the best captive audience of any investment class. So when I say captive audience, I mean that those who are living in their homes, in their built-to-rent or multifamily, those that experience their retail office space, they can sell in all ancillary revenues. They can market to them. They can have augmented reality, feed them different ads. So you have revenue streams everywhere. You can sell back the data to other companies that want to learn more. Like, they know more about a given renter and a resident and a user than any tech company ever could, because you're just really following from a tech companies like a Google, you're following like clicks and views. So online behavior. Well, I could follow real-time behavior. I know through cell phone tracking of people's behavior as they walk through given buildings in shopping centers. I know their accreditation scores, their demographics, psychographics. But that type of packaging, only a few landlords, specifically, I think you think of Simon and Simon Ventures, so Simon Malls, who owns a lot of the malls and shopping centers, probably every mall you've ever been to. They do a great work. They're working on that through omni-channels as well as rewards programs. So building that brand loyalty to Simon as well as all their subsidiary brands, and then activating them both online and offline. And then the landlord is really able to upsize their potential return on that given user. And then the inverse of that is the deprecation of Google AdWords and tracking. Mm-hmm. So with cookies. So as cookies go away, that allows it reduces the knowledge set of online merchandisers, right? But landlords, they can take advantage of that because they know they don't need cookies. Right. They're built in already.
Because that really flips I think that's a really interesting conversation to have, because that really flips the view of real estate on its side, or because it's interesting to see that you used to think that the real value in a building was the space that you own, right? But it could also be the data mm-hmm. that these buildings can produce, and manage that data and monetize that data, and you see a lot of that happening, but there's also a tough legislation to get through when it comes to that. And we don't have a lot of time today, and there's a lot of things and I want to get into the election too.
Yes.
But you've been on a lot of panels lately too, and we've been talking about AI, which is one of the biggest trends too. So how do you see AI affecting the real estate business or market?
So I think it is the best hallmark of the next iteration of real estate, and we've entered into this phase, as I was describing, the last 15 years, which is really just the digitization of real estate. And when I mean that, I mean I spent 5 years photocopying stacking plans and site plans and leasing books, just literally photocopying them and faxing them to other people, just getting them online, getting them on a computer. That was what we had to do. And then digitizing workflows, so getting people from Excel and email into a standard workflow. Now those all turn into a lot of fragmented silos. that don't necessarily speak well to each other. And you try to integrate those through APIs, so application program interfaces, how things lock together. Now, that has created repetitive tasks of downloading and then uploading and cleansing, but you apply bodies to those workflows. Those workflows, they're not necessarily technologies, they're more of just digital versions of your manual work already. What AI does, and a lot of these AI tools, is it eliminates that repetitive task. And I take a Isaac Asimov's second option of the future. The first one is we'll be out of jobs and we won't be able to write poetry, and it'll be really, really depressing. Second one is that it will
the robots will kill us all.
Yeah, it's the plot of iRobot, if anyone's a big Will Smith fan. But I'm on the second version, that it will free us up to be more creative, to be able to execute and be more analytical, to more empower us. And that's how we're seeing it in real estate, is transfer of information and tasks to be automated so that you can actually execute on deal sourcing and acquisition pipeline. Mm-hmm. Why we're seeing much more of a proliferation in the real estate world is due to this latest economic cycle. A lot of the layoffs led us with less teams, but now with repricing, and now tying back to your election question, in the U.S., as you see interest rates indicating to be to start to go through a reduction, we see a higher volume of potential value of deals, but those teams have less people to actually do those deals with. To evaluate and find alpha, you need to go pour through so many OMs, offering memorandums, and they're using AI tools to be able to identify and underwrite them faster. So that's one critical, real value area, elimination of repetitive tasks. There is an impact on the marketing side. So for broker brochures, you have automated marketing generation tools, but a lot of these are already existing, like templates. We're just calling them AI. And then you have the predictive analytics tools, which now also gets an AI flavor, but that's been around for a very long time. The problem with those, predictive analytics, OCR tools, generative AI tools for real estate, is all of the core information remains in silo systems. And you describe it as, my good friend LD Samuelson from Cherry put it so succinctly, is that data is not oil. It is not the new oil at all. Data is much more like sand. And to make sand turn to glass and a usable material, you have to fire that and do a lot of work to it. Otherwise, it'll pass through your hand like nothing. Right. So there's a lot of fundamental things to get to make these AI tools. But that is the number one driver, with staying power and business models that are revenue producing and make sense. And juxtapose that to the world of crypto and Web3 that they've all vanished, hopefully. But
no, not yet.
Yeah, I really hope so. But yeah, that's how I'd see the impact for AI in the real estate world.
Okay, great. So before I open up for questions, I just want to get into the election now too. So, we have what it looks like, Biden and his administration up against the real estate mogul, Trump, for a second time. It's going to be a debate tomorrow, right? So what is your prediction of how this election is going to affect the real estate market?
I was hoping they would wheel Trump out in like the Hannibal Lecter style thing. Yeah, I mean, we're entering a very strange phase. I'm also very into history, very much another phase of populist versus scenario, where it's rise of populism, and then you have what's happening in the Netherlands and a lot of countries which are going much more slightly nationalist, but there's always the ebbs and flows of what definition that is. I think there is we're almost protectionist phase of fear of one country dominating over another.
We have a lot of friction. More Trump's agenda.
Yeah,
right?
It's more Trump's. Yeah, and then on the flip side, you have a lot of on the Biden side, a lot of push for sustainable investments, and but then also a little bit more of open borders at the same time. But it's hard to tell from the national level. I mean, I'd always take a much more of a neutral view, as working on the tech side and the real estate side of we have to benefit. It's large. The U.S. 330 million people. In some calls, they call it almost like 12 nations because there's so many pockets of different countries. It's a very, very big place. the election, it depends on where you want to place your bets and money, but regardless, on the innovation, sustainability front, the landlords have made the decision. It is actually very good for business for them to install, regardless of the economic or tax incentives, they're started to identify revenue-producing models for using solar and alternative energy sources. You think of Daisy, which taps into natural gas at the building, geothermal energy at the building level. Like I toured Microsoft's campus recently, and you see the entire campus is fueled by geothermal energy. And that makes it more sense for a landlord who wants to, one, gain that ancillary revenue, reduce the cost, and not be beholden to energy companies.
Right. And that's actually a place where Europe is a little bit further ahead of the US. And we're still installing a lot of heat pumps here in Sweden right now, and that's coming down to Europe as well, where a lot of it's heated by fossil fuels and gas and so on. But how do you feel that the election is going to change that? If the Trump administration comes in, will all these incentives and the renewables and so on, will that go away, you think? Because he's threatened to do that.
I think the incentives potentially will be pulled back, but that does not change the momentum already around innovation and sustainability. So all progress is 2 steps forwards, 1 step back. That's pretty consistent, but we've gone too far. Like we've gone further enough that it's like a lot of those tax incentives in the green bonds were set up to build a base for green investing. But now that those green investments have built enough of a demand and a supply chain marketplace, the supply chain is already in place. It's to repeal that back would be the same way of almost deprecating, I'm thinking not necessarily the automobile industry, but take other industries that are so core and also in the fabric of the society. So to pull that back, you need a massive shift in thinking to be able to accomplish that. And you think of everyone's interest and obsession with Teslas and having buying an electric vehicle. Like that momentum's already there. So regardless of a repeal, which actually, in some cases you could say could be a good thing from the national level, perhaps on national budgets, but regardless, most of the decisions in the U.S. are made at a municipality level. There's federal funding, but each one of the cities and states, they make their decisions about what economic incentives they want to give for locally homegrown technologies and companies. I think of the success of the VC fund Rise of the Rest, which invests in non-gateway city companies, or really the tech hubs, so no New York, no LA, no SF, but everywhere else. And those all tap into local city level and municipality level funding to support those startups. So the elections as a whole, it can go. You think of it this way: you want to hedge, you want to look for what would be the scenario, the likelihood of scenario on or the Republican side or Trump more or less of what would they start to deploy into. So you think of more of expanding consumer, like the CPI index, like whatever would be returning money back to the consumer side. And then if you think of Biden again, you think of what would ever benefit on the sustainability and global economic track. So take either side and then look for whatever investment, but then hedge yourself back to the most consistent world. And this is why I work in the real estate tech world, is because the consistency is that people are always going to need to be in space. And then they're always going to want to innovate on that space, and that's the technology side. So think of like data centers, logistics, and last mile. So what I want to be on a global supply chain side, that would be more Biden. I look for much more larger warehouses in northern Mexico for nearshoring, or do I want to be on last mile for improved e-commerce distribution? So that's how I think about it from like a real estate investor and then a technologist.
And if you're in hotel and casinos, then you might want to go with Trump.
Yeah, if you want more casinos, the hospitality industry is an interesting thing of what version would you want more of the global, or not going to say global, but much more of the larger resort style, or if a lot of countries start to become much more introverted, then you look for the smaller, more boutique hotels that are for local attractions. So you can take either side. That's the real neutral view of how if you want to do hedging on your real estate investing.
All right. Do we have any questions for Zander? And how do we have a little more time, Roger? Or any questions? Otherwise, I'll continue. All right. One for Roger.
Please, Roger.
From Roger. No, yeah. So now, I mean, we've been met a couple of years now, Zander. So when we're traveling around, we see the startup and scale up from Sweden, the ecosystem. So one of the thing is, what I'm wondering is your recommendation to the smaller company to scale.
Mm-hmm.
So what we have a challenge with, of course, is, okay, we're going to scale in Sweden. As you know, Sweden is a good toolbox, sandbox. But how do you do after that? So what is your top 3 priorities to the startup and scale up who's just coming into the PropTech industry?
Yeah, I mean, there's been the paradigm of, or at least the rule of first mover, first loser. So looking for the replicants. There's been a lot of the companies that we looked at, we saw from Europe, from APAC, were already existing models. So think of co-working, think of spaces as a service, think of some of the appraisal toolkits. There's almost too many of those in some cases. So you have to look for what is the differentiator of those types of companies. And my recommendation, outside of having .ai in the name set, because it will be helpful, but is to look for a systemic issue inside of all of those companies, something that can be transmuted across geographies. So you think of, a problem that happens in Swedish real estate. So if it's under, potentially on tax incentives. So tax incentives applied back to the property and wealth preservation. If you solve for, if I'm constantly looking for companies that are solving for a few key things, tax incentive and wealth preservation is critical. That is an endemic and systemic issue, globally, or in most of the developed nations that have a written tax code with it tied back to property value. So if I was to say a company to enter into the space, I'd say solve for that here. You have a pretty complex tax code, and that does impact the capital workflow as it ebbs and flows inside of the Nordics. Then replicate that strategy into the US. So solving in a way of partnership between government, that's why I tie back to tax, and private investing. So you think of zoning, you think of entitlements, you think of tax. Those are the areas that are big problem sets. And then back to another one that I've always hear about is insurance. So with climate change and the potential economic windfall effect of climate on real estate investing, it has led to rising premiums, depending on your relationship with your insurer. If you solve for that here in Sweden, you take that model and apply that back to North America, that's where you'll see outsized returns. I mean, it comes down to those 4 different categories I described, but it's locally solving for those and not going for necessarily a general replicant of another servicing company, but solve for the true pain. A return to office would be interesting, but that's more of a social issue than it comes down to a real estate issue. I mean, the real estate folks were now repositioning their assets. Instead of our office, we're now multifamily. So not really a tech problem, but tech can help for the friction points, especially now we're at Almedalen. If I was to advise any of the startups or technologists or entrepreneurs here, I'd say, get with your politician and local governor, find out whatever mandates they're putting out, and find ways of partnering with them to solve for that on a real asset basis.
Did that answer your question, or?
You're making $1 billion, Roger.
Because the question is also, I mean, if I continue to along your trail of thought there, I mean, how do you make a business that's scalable and that can export to the US? I mean, one of the things that you need to be aware of is, of course, the different laws and so on. And I'm thinking about, just to take one example, I'm working with a company that does biometrics, right? Mm-hmm. And you can access buildings, offices, your home, and so on with you as the key. So the integration, if you can make it with the software companies or the big giants like Apple and Google and so on, there's a big chance that that solution would work internationally. Or how do you test locally for something that can scale?
Yeah, that's it's a tough one. So you saw what happened to, we were early investors in Latchel, and it's difficult on the hardware and distribution side, and then partnering back up to the key coding. There's a company called Swift Connect, which did partner up with Apple to upgrade the access controls in every asset, regardless of the hardware that existed. So just an operating layer tied back to the access control company, it's access control hardware itself. But I've only seen it deployed. This is a problem of innovation, technology, product development, and actual deployment. I think I've seen it deployed in 3 buildings, knowing that it is there. And this is the investors in the company. They own the full stack, vertically integrated. They can control what is deployed. So access controls and biometrics, it's difficult, but you have to truly partner with the services providers and the security companies. And keeping in mind, Lucien Neymar, who is one of the gurus of cyber technology in the built world, is writing protocols around building security, because buildings now can be held hostage if you want to hack into them. You control the heating, you control the key coding, so you can't get in and out. That has happened. There's been ransom around buildings, and which is actually quite terrifying. The smarter we make buildings, the dumber they actually get. So I'd say the importance for a Swedish company in the U.S. is to greenfield.
I like that. The smarter you make the buildings, the dumber they get. It's
a fascinating conundrum that we found ourselves in. The more you deploy of IoT softwares and access controls, the less they speak to each other. So that's where these IoT unifiers are extremely important, and setting up protocols and integrations between them and having them speak to each other. I know we just talked about Serenity and the team there, which is setting up great integrations across each other's. That's critical. But from a partnership and channel distribution, you have to work with one of the more incumbent main brands of real estate investing that has a vertically integrated services company. That's the easiest way to do it. So a landlord that has the ability to invest and support your landing, because if you talk about biometrics, you're talking hardware, which is a high capex upfront with a long-term view for potential return. So you have to invest a lot up front, and then maybe you will yield back. But you have to have someone that has that type of balance sheet to handle that, as well as the services component for them to mandate the distribution inside the properties. Right. You can't go for, say, an investment management firm that allocates down to an operator and JVs. They'll have influence, but they won't have control. Real estate tech investing comes down to controlled outcomes, at least an attempt at controlled outcomes. And you partner up with a vertically integrated, or at least parts of their value chain. So say owner, operator with servicer. If they have all 3, that's the best type of company to partner with, especially if you're doing hardware and IoT.
Right. Because I guess I'm going to round off with this, unless there are any other questions, because another success story, it's not really a PropTech company, but it's an IT security company called Yubico here in Sweden, and it was IPO'd, and it's gone up over 100% since. And I guess what they did was that they started the company, or the founders moved to Silicon Valley. And they started by getting integrations with Google and so on there. And then they came back with those solutions with Google as a customer and so on, and then implemented those biometric keys and so on into the computers and made the company public here in Sweden. So I guess my question is, who are the new gatekeepers of the buildings? Could those be, the Alexas and Microsoft and Siri and so on too?
Yeah, the gatekeeper is the educated landlord with the technical wherewithal to do this type of deployment. It can come down to your big names.
Key, I'm saying that maybe the phone will be the interface and not the actual hardware that's sitting on the door, for example, and so on.
Yeah, so that's where, as I mentioned, Swift Connect doesn't necessarily matter around the hardware that's been deployed, because you do a lot of consistent upgrades to those hardware, which is more capital infusion. When we could just say we don't need that, we just install a security guard and then they can communicate with you. So just have a doorman. Yeah. In fact, the low tech might be even in some cases better. Just a tech-enabled servicing team that knows the people, that has awareness. You can take a Danny Meyer model of setting the table. So like 11 Madison, where they empower the waiters and the the hostesses to know more about the guests, and it makes it more of a welcoming, engaging experience. Like when I go to certain call them almost the high tech and very difficult to get into assets and buildings. Absolutely hate it. Like we sign up for the QR code before, and then you have to do 3 layers of communication before we even get close to the lobby. Like I'm just not going to go to the building. We can Zoom. That's fine. I don't need to come in. It's such a friction experience versus the hospitality-driven experience. I mean, the gatekeeper is going to be you think of the property managers. So CBRE, JLL, Cushman, like their property management teams, they now have tech teams that will make quick decisions around what technologies. You don't need to do integrations. You need to do education and empowerment. So it's a shift because a lot of the technologies are ubiquitous and replicants, so we can't tell the difference of them. But what matters is partnering up with those servicers and the security teams who would then be empowered to know about how to use these technologies to make it a much more hospitality-driven experience for the resident and tenant.
So having good Wi-Fi is still the key.
Yeah, Wi-Fi.
All right, unless we have any last questions, I think that's it for us today. Thank you, Zander, for joining us.
Thank you, Joakim. Appreciate it.